Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. Guys, welcome to our Tuesday Night Live. I'm really excited to share the screen with Shad Marquitz. We were introduced by a mutual friend of ours, John Rubino, and many of you that watch our Tuesday night show, or just our podcast in general, know John Rubino is no stranger on our channel. Seems that most of our audience loves John. So when he introduced us to Shad, I said, you know what? We got to talk to this guy. If John likes Shad, then we must like Shad. So Shad, welcome to our Tuesday night.
I'm getting a little bit of an echo, just as a heads up, in my mic here. I'm in my ear headphones.
Do you have any other tabs open that you may need to close out there, possibly?
There you go. That's what it is.
Sometimes people leave YouTube on, they leave it open and then it echoes. I've been guilty of doing that myself a couple of times.
That's what it was. I was so excited about the streaming here. I was already watching it. But yeah, John Rubino is a good friend. We have him on our show, the KE Report, the Cortland Economics Report. We mostly cover the resource sector, but we do bring on macroeconomic guys, hedge fund managers, people that manage family offices, people looking at the lay of the land in the macro landscape, and we dig into currencies. We dig into interest rates. We look at what the Fed's doing. We look at what the Fed's not doing. We look at what's happening in geopolitics and how that affects the world. And obviously commodities are the raw materials that make the world go round. And when John mentioned your show, I snapped over to it and saw a couple of folks that are friends of the show. We were just talking before this about Bob Moriarty. He's a good friend of mine. He's helped me in my career. Adam Taggart that you had on the show. We actually rode in a cab together from the New Orleans Investment Conference, and he was sharing with me how he was building his YouTube empire there, and he's just a solid guy. So when I saw some of the guests you had on, I knew we were birds of a feather.
Well, we're glad to add you to the group, so welcome. And we have a lot to talk about tonight. Interestingly enough, commercial real estate is all over the news, the housing market, of course, and WaFd Bank. We'll bring that up a little bit later on in the show. As many of our listeners know, I traveled to Washington to interview Brent Beardall, the CEO of WaFd, and they're in the news. Bank of America is buying about 2,000 of their loans, commercial loans, multifamily loans to be more specific. So we'll chat about that. And guys, we'll take your questions tonight live. If you have any questions, comment them in. We also were a little bit late, my fault, in the poll this evening. I have been slammed over the last couple of days, over the last 30 years. But more specifically, today was a very busy, hectic day. So I was a little late in thinking about that. But the poll is really a spillover from last week because you know how much I love our audience, and you guys let me know that, hey, it really wasn't an accurate way to ask how much money people have in the bank because I didn't preface it with after you pay your bills. So we do have that poll. I would love for you guys to cruise on over and vote so we can kind of get an account. As we've said in the last couple videos, a lot of consumers are broke and struggling. The economy is terrible. And we're seeing it show up a lot more now with the big slowdown. Of course, construction workers are slowing down. But anyway, Shad, give us a little bit of your background and, how did you get into the commodity space?
Yeah, it's a wild journey. In 2008, 2009, during the great financial crisis, I was an insurance broker, I was a financial planner, and a banker. And I was watching the financial world crumbling around me. And I thought back to my early days of numismatics and collecting coins. I thought I better look into some gold and silver. This is getting a little dicey. When we saw Lehman Brothers and Bear Stearns and everything going down, it was really a wake-up call. And I was sitting down with clients and families every day, talking to them about the future. And when that was all going on, they couldn't see it. And so I started looking for insurance on the insurance. And to me, that was the precious metals sector. And as I got interested in precious metals, it was really coming out of that great financial crisis that I started realizing, hey, there's also companies that pull these metals out of the ground. And so I started getting into the resource stocks, and I started looking at the whole commodities complex and looking at, what about copper? What about nickel? What about lithium, uranium, nuclear power? What about all these different areas, oil and gas? And so it became a fascination for me. And then it became something I did on a daily basis, was trading commodity stocks and looking at ways to diversify outside of traditional paper assets. And then about over a decade later, I came to work with the KE Report as I was an influencer online, and they said, why don't you just come and interview people? You love this space, you love this sector. And after that, I've recently started a Substack page as well, just communicating to the market what I'm doing in my own portfolio.
Well, I know a lot of people are looking at, where do they put their money? Where do they put their cash? I think it's fair to say that hyperinflation is right around the corner, at the very least stagflation for a period of time. We know it's not coming down. The numbers don't make sense. And we don't see salaries going up, like some of the reporting that we're getting. In fact, salaries have actually come down. But let's kind of, when we're trying to advise, our audience, I'm a real estate guy, right? I mean, I'm a real estate broker. I have agents. I manage agents. We have a broker network all across the country that helps buyers and sellers, tenants and landlords find good agents. It's not easy to find good real estate agents, but we have a lot of people that are questioning whether even real estate is a good buy right now. You have certainly a lot of bulls that are saying, buy now. If you don't buy now, you'll be sorry, that these assets, real estate assets, are going to continue to rise. The real concern that we have is not just the fact that real estate prices could or could not rise. Maybe long term they'll rise, but not during the short term. I believe we're going to see prices come down still. We're really seeing it show up in a lot of areas in the country. But what really worries me with that asset, if it's not land and it's actually an improvement, a house on the land or a building, commercial real estate's taking a hit, but let's just stick to residential, the cost to maintain that home now has never been higher. It's never been worse. I mean, Shad, you were in the insurance business. The insurance is terrible. Taxes are going up like crazy. So I just want to take a couple minutes to kind of start us out and sort of lay down some of the foundation of where do you put your money. I talk to landlords all the time. They're really fed up of the residential housing market. A lot of the laws that are in legislation right now are against them, or being proposed or even being passed, make it really hard to get people out. And you can see it showing up everywhere. And so a lot of people are thinking that that's not a great place to be. And if you have your money sitting in dollars, I was just talking with a real estate broker on our network, Phil Simonetta, he's down in Florida, and he was saying, he liquidated all of his rental properties over the last couple of years, and he is putting them in short-term bonds to kind of keep it at least liquid and I guess as safe as possible. But tonight we're going to have Shad tell us what we should be doing. But let's go ahead and talk. First, I want to, Shad, and I know you can talk to this too. Let's go ahead and talk a little bit about commercial real estate because there's a REIT that's in the news. So let's start with, by the way, like I said, commercial real estate is really not pretty right now. But first up, this Wall Street Journal article, it's titled "A 10 Million Real Estate Fund is Bleeding Cash and Running Out of Options." So this fund here is a giant, okay? It's a $10 billion fund, actually, not $1 million fund. I think that headline is wrong. But the Starwood Real Estate Income Trust, also known as SREIT, has a long line of investors now wanting their money back. And according to this WallStreetJournal.com article, in the first quarter alone of 24 investors, they punched the fund dead square in the nose because they want more than $1.3 billion in withdrawal requests were received by the company, but the company only paid out $500 million of the withdrawal. and that's all it was actually satisfied. But we can look at a couple charts here, just real quick to let you know kind of the severity of this. But anyway, this is broken down into quarters. This is titled Street Redemptions here. And you can see that they're really taking a hit with returning the money. So back in 2022 first quarter, you could see how little bit of withdrawals investors were requesting back then, or what they were paying out. And this is, now you're looking at, ever since really the third and fourth quarter of last year, this fund has not been really doing that well. And then there's another chart here as well, that is Street's fundraising monthly chart. And you can clearly see that they're not raising enough money to outweigh, what their withdrawal requests are. Now, these charts are sourced from Robert A. Stranger and Company, and they can be found on wallstreetjournal.com. I'm a subscriber to them, and I enjoy reading it. So you guys, if you're not subscribers to Wall Street Journal, free plug for them. Not making any money on subscriptions, but I like it. Street was launched in 2018 by Starwood Capital, a private equity firm headed by Barry Sternlicht, the storied real estate investor and founder of the Starwood, which is a hotel chain. Street raised more than $13.5 billion in equity, which it used to buy more than $25 billion in real estate assets. You like how that's done. They take, smaller amount of money and invest it, and go deeper, in debt with loans to make up the difference. But Street owns hundreds of properties throughout the country, mostly warehouses and rental apartment buildings in the Sun Belt. Now, according to this article, Starwood has three options right now. I mean, this is kind of like not the best options either. They could either sell properties, which, I'm in the real estate business. I have done commercial real estate for quite some time. Any kind of real estate is not a good time to sell when you're in distress, because the Wolverines can smell it. And they actually really start gouging at you to steal the property as cheap as they can. So now's not a good time when you're in distress. Never a good time to sell. So the other thing that they could do is they could raise more money. Well, I mean, they could get loans, or they could halt the redemption period, which would be fatal because they'd never get more money if they stopped giving people their money back. So thoughts on this, Shad?
Yeah, I mean, I think this speaks to a larger picture of a lot of these real estate investment trusts having redemptions, people wanting to get their money out of the market because they understand that higher for longer interest rates are eventually going to be a pressure cooker for buyers coming into the market. And we also have stickier inflation. And so when you think about stickier inflation, to your point earlier, the cost of repairs, the cost of maintaining these properties are only going up. So some people want to hit the escape hatch. They want to get out of the market. And that's why you're seeing very little fundraising and a lot more redemptions. I do think that it's going to be a pressure, interest rates staying higher for longer, which obviously raises mortgage rates. That's going to be something that we haven't seen really surface yet because there's been a shortage of inventory. That's the only thing that's been saving the housing prices. But we're not seeing it in commercial real estate, to your point earlier. And so I think that eventually when the new home buyers dry up and when the home builders say, hey, there's no point in building because there's nobody that wants these homes, I think you're going to see a stagnant real estate market. Prices will probably drop, I would expect, by 10 to 15%, possibly more. And in that kind of environment, people want to get out of the way of that and get out of these funds. And that's what you're seeing in the numbers.
Well, there's something else that's holding the housing market up too, and that's jobs. So we've despite the fact that the job reports seem to be cooked with the revisions that come out, the fact of the matter is people still have jobs, right? We're not seeing the massive layoffs. I don't believe unemployment's as low as it is, but there are a certain amount of people that just don't want to work, and after a year they drop off of those numbers anyway. But I think when we really start seeing more layoffs as construction slows down, we're going to see blue-collar workers get laid off by mass scale as this big building boom that we've seen of massive inventory from apartments being built, high rises across the country. But yeah, you're right. I mean, inventory, but I don't know. We'll see if the government can continue to prop up the people as they lose their jobs, like they have, more than 1 million households, saving them from being foreclosed, and that still continues today. What else do you think about? Do you think REITs are a safe investment right now?
Strangely enough, I had somebody ask me that yesterday. I don't think all REITs are bad. I think there's some that are, it depends on what they're positioned in. But I do think that in general, over time, real estate's a great investment. In the short term, it's a little dicey. And to your point about the jobs, if we start seeing people that are being counted in those job surveys twice because they're working 2 different jobs or 3 different jobs, if we start seeing more pressure, and if we start seeing people that are living on plastic, living on HELOCs, running out of their COVID cash, if we start seeing that hit with now a job loss, I think there's going to be more and more people that go from home ownership to renting, whether that's condos or apartments or multi-family units. And I think that you're going to see certain REITs that get clocked in a bad way. So I think you need to be selective. I think you need to look at what's inside of them. What assets do they hold? Where are they exposed to? What jurisdiction?
What do you think is the most dangerous asset for a REIT?
Well, if they are focused on commercial real estate, I mean, I do think that some of those are going to have a huge problem because a lot of those office buildings, I live in Seattle, and there's buildings downtown here that are half vacant, if not all the way vacant. There's big warehouses that are now sitting empty. There are shopping centers that have nobody at them. And I think if you're holding a basket of commercial real estate, that's far riskier than residential. Some of them that are actually holding big multi-family units and apartment actually may be the place to be, because I think there's going to be a shift from less home ownership, more renting as the millennials and Gen Zs get into the mix here, and I think those REITs will be positioned more effectively.
You said warehouses being empty. When you look at, and a lot of people don't realize that they think a warehousing space is something that's fail-proof. And actually, it's not true, because warehousing doesn't mean manufacturing. So you can have warehouse space in a non-manufacturing zoning. They put offices in the front and they call them flex space, and they build a ton of this material. In fact, here locally, we see a lot of churches going into these spaces because they can't lease them. So they need assemblage, they need big areas, and then the parking, of course, becomes a problem, because when you assemble, when you're looking at a warehouse, you're really looking at like 3 spaces per 1,000 square feet is what you're typically getting. 3 parking spaces per 1,000 square feet. Well, if you lease a 10,000 square foot building, that would give you 30 spaces. And that's how they design a lot of these warehouse districts or flex space districts. So it becomes a real problem, and I'm going to tell you why. Because this is a huge mistake from a zoning standpoint, and also, in my opinion, from an investor standpoint, because everybody thought that this Amazon effect was just going to continue, and that people were going to continue to buy like they did when everybody was sitting at home, and that we would be shipping everything and no one would be going into stores anymore. And that's just not true. So the real winners are the ones that have the warehouses in the box, like the Sam's and the BJ's and the Costco's, because their warehouse is full with inventory, right? And you can shop it. But when they build these warehouse complexes or flex space complexes, they didn't plan enough parking, number one. And number two, they don't allow outside storage, most of them. So what is really going to be building as we start seeing this shift come from white collar jobs to blue collar jobs, we're really looking at, we have nothing to support in the community contractors. There are no contractor yards. So these warehouse spaces are great, but you can't put anything outside. So you can't store your brick or your block or your wood or your tools, your bobcats, that kind of thing. Big dumpsters. You got to have all of it inside. And so this is a major problem, I think, that will affect this warehousing district because they didn't really think about the true nature of a warehouse and make it truly manufacturing zoning. So that's going to be a problem. Office spaces, I mean, we saw it coming before COVID. Businesses were reducing their square foot, needs, doing more open workspaces. That's just started the ball rolling. But all these office buildings that are sitting there, we got a major problem. What do you think they'll do with them?
Well, I think they'll get rid of them for 30 cents on the dollar, and you'll see a serious problem in the regional banking sector. I think that they'll have to unload them. I think there's a lot of people, now that the cost of capital is more, when some of these loans roll over and they're faced with a higher interest rate boogeyman, they're going to get rid of the properties for pennies on the dollar, which could be an opportunity for some people in the next cycle. But then you wonder, will all these people that have started this work from home movement ever want to go back to offices? Will we ever staff up the way we ever did pre-COVID? I don't know that we'll ever return to that old world again, but I think it's going to be a serious problem for people holding these properties, and I think they're going to unload them on the cheap. Again, it could be an opportunity, but it's going to be a serious problem for the banks.
But what do you do with them?
Well, you have to repurpose them, and so like you're saying, using the flex space inside of a warehouse is really not how they were designed.
Yeah, but you're not doing that with an office building. You're not putting work.
Yeah. So there's certain buildings that it's impossible to repurpose. There's some that could be. And we may have to be innovative and look for businesses that can utilize those spaces in new ways. I was listening to somebody on your show saying that maybe they could bring all the car dealerships into these big shopping malls and repurpose them that way. There's got to be some new thinking, but I think it's just a fundamental change. I think that you're seeing a paradigm change in commercial real estate.
I want to, first let's talk about WAFED. So there's an article that just came out today on Yahoo Finance. WAFED, which used to be Washington Federal, they rebranded. Trims CRE, which is commercial real estate exposure, agrees to sell CRE loans to Bank of America. In an effort to trim its commercial real estate exposure, WAFED entered an agreement to sell 2,000 commercial multifamily, and that's why I wanted to really get to this, because a lot of people think we're going to repurpose these office buildings into apartments, which is disastrous because we have a glut of those right now. But I'm going to show you in a little while what will happen if we, we'll save it. But anyway, 2,000 commercial multifamily real estate loans were sold to Bank of America for $2.9 billion. Now, here's the kicker. The loans have an unpaid principal balance of $3.2 billion. Guys, that's a $300 million about, because these aren't exact numbers. I'm sure there's a couple dollars and cents somewhere in there, but about $300 million haircut that WAFED is taking. I don't know how much money they make, but geez, can you imagine taking a $300 million haircut on selling loans? You must really be concerned. It says in this Yahoo article, also notably, WAFED's asset quality has been weakening over the past few years. Provision for credit losses increased in fiscal 21, 22, and 23 as the company continued to build reserves to combat the worsening macroeconomic backdrop. Further, in the first half of fiscal 24, provisions increased because they bought this Luther Burbank Corp. And that was happening right before or right after I met with Brent down in at their headquarters in Washington. But let's play this clip. So many of you, if you hadn't seen that video of Brent and I, we got a little clip here for you.
Why do these institutions fail when they try to evolve from a thrift to a commercial bank? And the number one factor we saw is it's so hard to be disciplined. It's so easy to cut corners. And the way people cut corners when you want to grow into a commercial bank is you make credit quality compromises. And that's one thing that we refuse to do. Credit quality, to us, that is the DNA. That's what allows banks to survive for 100 years through the cycles. And so it's been a very, very slow process for us as we've evolved. both the left-hand side of the balance sheet and the right-hand side of the balance sheet to become a commercial bank. But we feel like we've done that pretty successfully, and I'm pretty excited about where we're at today. And as a result, even with the increasing interest rates, with the Fed going up 525 basis points. Today, we sit here, our margin is still 2.91%. So very pleased with how we've been able to evolve to become a commercial bank. You contrast that with Luther Burbank, who...
All right. So what do you think, Shad? Sounded pretty optimistic just a couple months ago.
Yeah. And just a couple months ago, back in February, think about Jerome Powell. He was talking about the regional banks, and he said, look, some of these banks maybe have to merge or just be shut down. He doesn't think the big money center banks will be, but he admitted that some of the small banks will have to be closed because they have concentrated exposures in commercial real estate. Well, if you start seeing that happen, if you start seeing a ripple effect or a domino effect, one bank goes down, just like we saw a couple of years back with the banks having the problems that all started off in early 2023. If we see another, everybody thinks that's in the rear view mirror. If we see another round of that where banks start going down and because of commercial real estate, it's not going to cause a run on the banks. It's going to cause a loss of confidence in most of the mid-tier banks and smaller banks. There may be a few regional banks and smaller community banks that are okay, and the big money center banks will probably be okay, but there'll be a contagion effect. The other banks were bought out, if you remember, by larger banks. Well, there's only so many they can absorb. So if you start seeing dozens go down and we start seeing those assets daylighted, that they're toxic assets, you're going to have a problem again, and it's going to rear its head, and it's going to possibly be the next black swan that everybody thinks is forgotten about.
Do you think banks, for the most part, are insolvent?
Not most banks. I think a lot of banks are fine. If you look at the financial sector and look at how it's been tracking this year, it's a party. It looks like they're okay. The big money center banks are probably okay. I think there's a lot of skeletons in the closet and a lot of banks that are holding bonds that are upside down on because interest rates went up and the bonds crashed. I think that's a problem. If there's a bank that has bonds that have crashed and commercial real estate that's a problem, and they get hit with a double whammy, those will be the problematic banks. So not all banks, but definitely enough to be concerned.
Shad, do you know that banks, all banks, 70% of their assets are commercial real estate?
Well, I don't think that every bank has the same kind of risk on the bond side. And that's really some of those bonds being upside down was what caused some of those banks to go under just a year or two ago. I think it's the combination of too much, and it depends on what area you hold the commercial real estate. There's certain cities that are more in trouble than other cities, and there's certain areas of the country that are more, and there's certain industries that if you're holding certain kinds of industries, you're going to have so much exposure to a certain maybe sector. Maybe if you've got a lot of warehouses and a lot of manufacturing, that's different than commercial banks that have been lending out to like oil and gas companies, or it's different than companies that are lending out to maybe office structures and buildings in a robust economy. If you're in a city that's seeing its population leave, if you're seeing an exodus out of that city, the commercial real estate's a ghost town. Those banks are going to be more exposed.
Commercial real estate and the residential side is anything more than 4 units. You can get a commercial loan up to 4 units. You can even get a fixed rate, or I would say you can get a residential loan, rather, an investor loan up to 4 units. But people that are in the business of having even single-family rentals, most of these investors, if they're not a REIT or a fund, or they're using other people's money, they still take on debt, but a lot of it's leveraged through investors, and they just get wiped out. But if we're talking about mom and pop style landlord investors, they're commercial loans. These are loans that are 5-year loans on average, a 5-year loan. It balloons in 5 years. They may amortize it over 25 years, but it's ballooning in 5. How do you, when people, it's like giving a kid candy. Besides the fact that it rots their teeth, they want more candy. Your body gets charged on the candy. You want candy. So what happens is you give these investors, most investors, bank money. There's people out there that were saying, "Oh, do the Burr method, refinance it essentially, take all your equity out of it, and then invest it again." So a lot of these investors have zero equity in their rentals, and their rents they're only going to get so much in rent, and they're basing it on a 4.5% interest rate loan. That now here we are in 2024. These loans are ballooning, and now they're looking at 8%, 9%, doubling. We all know that when they refinance, most of your schedule is in interest charges. Your payment is packed with interest rate, interest charge, not principal. How can these banks not be getting ready to take a massive hit? I mean, how can you tell me what asset? I'm just pushing back a little bit. Shad, how can they be okay? How can they possibly be okay?
I don't think they are okay. I think that, like you're saying, the higher cost to capital, when you go from 4 to 5% mortgages to 7 to 8% or loans and business loans, when those loans roll over, that's why it's not an event, it's a process. I think with this higher for longer interest rate is going to be a major problem when these people have to roll their loans over when they balloon out. And I think a lot of people are going to be in the hurt locker, and that's going to mean that the banks are as well. So I don't think that all banks are safe. I just think it just depends. I don't think that all banks are at risk, but I think there's enough banks at risk from this commercial real estate that it's going to be a serious problem. And the higher cost of capital, this higher for longer trend, is going to be a process where not just individuals' rates, but as municipalities, as cities' loans roll over, we're going to see more and more carnage because of this. And it's possible that the Fed has tightened for too long here, and that just like it took them too long to get going on the tightening, now they've tightened for too long. They've taken too long to get going on the loosening, and it's going to show its head, I think, over the next 12 to 18 months.
Yeah. I think that commercial real estate we're going to see one of the biggest downturns we've ever seen in commercial. In fact, offices, I can't even imagine what's going to happen in these buildings. I want to take a look, and even hotels, all the motels we have in the country. I want to take a look at this. This is an article on TriCityHerald.com. This article is titled "Reality Check: 160,000 unpaid taxes, vandalism plague developer whose micro apartments eased rental woes." Now, as we talk about this article, I want to remind everybody that the administration believes that the fix of the affordable housing and the emptying of office buildings will come together as a great way to repurpose these buildings into offices. Well, let's just read a little bit here. 3 years after Fortify Holdings began buying Tri-Cities motels and converting their rooms into micro apartments, its legacy is mixed. The Portland, Oregon-based Fortify spent $38.1 million to buy 6 local motels and nearly $13 million more to convert 5 of them into tiny apartments. Through its efforts, Fortify added more than 800 new rental units to the Tri-Cities notoriously tight housing market. But it has also fallen behind on its property taxes, and the city of Kennewick has publicly suggested it might demolish one of Fortify's property after it became a public nuisance. The result is a measurable loosening of rental housing market. Good news for renters, unless you live in one of these nuisance buildings. But its record also includes $160,000 in unpaid property taxes, and the appearance it abandoned a Motel 6 were intended to provide homes for seasonal agricultural workers, but which has fallen into disrepair and is boarded up. Public property taxes reveal Fortify has an inconsistent record of paying property taxes in eastern Washington, where the Tri-Cities isn't the only place where it executed its hotel conversion strategy. Now I'm interested in what they call a nuisance property. So it says nuisance property. The Ken, formerly the Motel 6, is an outlier in Fortify portfolio. Its 5 piers cater to renters willing to pay $900 or more for tiny studio apartments. The company initially intended to convert it to micro apartments. Midway, however, it withdrew its building permit application and indicated it would go in a different direction. Seasonal housing for farm workers was the original intent. But bunk beds were added and residents on site in 2023. Last fall, however, it fell empty and began attracting the wrong kind of attention. The city of Kennewick ordered Fortify to secure the building when it missed the deadline in December. I hired a contractor, they boarded it up, and now they're billing them back $16,000. This is, imagine this times 100,000 across the U.S. You can't make them expensive apartments. People can't afford them. So what do you think? What do you think we'll do with these office buildings?
Well, I know I initially said at the onset we could repurpose them. That doesn't shed a very nice light on repurposing if they had to demolish the building because it became a public nuisance. I do think there's a trend. I live in Washington. I know where Kennewick is, and that's right in my neck of the woods as far as some of the plans they have here, and I'm sure in other states, to do micro housing. How can we stuff a lot more people in a lot smaller space and repurpose these buildings? I think if you maintain it and you do it right, there's chances it could be a good idea. But when you see examples like that, you could see a lot of rot across the whole country, and them being upside down on the taxes. I think the other aspect is they can't afford the renovations. They couldn't afford to fix it up because of inflation and the high cost of everything. So you're going to see a lot of these properties fall into disrepair.
So you think they'll just get torn down?
Some will. Sometimes the bulldozer is the best route forward. It's unfortunate that they can't be, but I think there's going to be instances where certain buildings can be repurposed. Not enough to save the whole space, but certain instances where it works. That's not a good example. That was a bad example of where trying to repurpose the Motel 6 into micro housing turned into a disaster. And we'll see more of that, I'm sure.
Well, I mean, it's I can't imagine the cost of converting a 40,000 square foot office building into 1 and 2 bedroom apartments. I think that will be, cost prohibitive. I have been tracking some of this multifamily, just a lot of the glut that's happening right now. And I've actually, I've done some traveling, and I was just at one of these multifamily complexes, and they want a ridiculous amount of money. I mean, you're talking about, I was in Tennessee, a 1-bedroom apartment in this brand new complex outside of Nashville. They want over $2,000 a month. It is so loud inside of these apartments. I mean, you can already start to see where the neighbors or the tenants are complaining because they put these amenity-rich buildings up. It looks nice. They do fancy faucets, cool colors, nice flooring, tile or laminate flooring. But there's nothing between the walls that soundproof these things. And when you put these high-rise buildings together and a bunch of noisy neighbors with barking dogs, your life is hell. Right, but they put a 2-lane bowling alley and a foosball and a pool, a real nice pool with waterfalls and all kinds of cool grills and stuff like that out there, which, by the way, nobody was using when I was there. Actually went to a couple apartment complexes just to check it out and see. The interesting thing is that people aren't talking about the downward pressure on pricing on apartments right now because they don't want to drop their rents, so they're now offering 15 months, a 15-month lease for the price of 12, or they're giving them 3 free months for if they sign the lease right away or whatever. But I have one apartment complex actually told me, the leasing agent, when she knew I was a real estate broker and was very standoffish, which she probably didn't know that I have a podcast, but she was very standoffish when I was asking a lot of the questions. And then finally I was talking about pricing, and I'm like, well, your pricing is not coming down. She's like, oh, well, it's because of our vacancy so low. I'm like, really? And she said, but you know what? you can watch our website because the rates change every single day. She's like, so tomorrow it may be $20 less a month. So, they're not even, and I said, really, that doesn't even sound honest. So I don't even know if I'm signing a lease, what price I'm going to get. And so I said, you don't know? And she's like, oh no, they don't tell us. They keep us in the dark. And I'm thinking to myself, man, this freaking apartment business is about to come crashing down. But check this article out on CNBC. It's titled, Here's Where Rents Are Rising and Where They're Falling. Multifamily rents in April were 0.8% lower than they were the same month last year, according to Apartment List. It says rents cooled because a massive amount of new supply entered the market with still more in the pipeline. And then it says apartment vacancies are also climbing, hitting 6.7% as of March, marking the highest reading since August of 2020. Roughly 18,000 single-family built-for-rent homes were started during the first quarter, a 20% increase in the first quarter of 2023, according to an analysis of census data by the National Association of Home Builders. Over the last 4 quarters, 80,000 such homes began construction, representing a nearly a 16% jump from the prior quarters. Says that Seattle saw the highest year-over-year increase in single-family rents at 6.3, followed by New York at 5.3, Boston at 5.2, and those leading the declines were Austin, Texas, down 3.5%, Miami down 3.2%, and New Orleans down 1.4%. For the first time in 14 years, however, single-family attached properties, namely townhomes, posted a year-over-year rent decline. That's not good for investors.
No, and I live in Seattle, and I see it every day where people's cost of living is going up to the point where they're having to work extra jobs, where they're having to decide to cut other things out of their life. And oddly enough, my family lives in Nashville. I go home every year for Christmas, and I see all of those condos buildings and all of those high rises they built. They put them up quick and they built them quick. But like to your point, a lot of the people that have moved in there have decided it is a nightmare living scenario because of the noise, because of the congestion, because you're sandwiched in there. So there's this big movement to run everybody into these large multifamily units. And then there's a lot of people that get in there and decide maybe this is a bad idea. If more and more people, if more of these places become more vacant, if there's more of an inventory of them, I think they're going to have to slow not just the building process, but they're going to have to adjust the rates accordingly. And with rates going up so high, people have to make serious decisions right now. We could get to a point where we see that teeter-totter reverse and where we see people saying, hey, we'll take any amount. Let's just get some more tenants in here. And if that spiral starts starting, then you're going to have real problems in these holders of these large multifamily units.
I think the first article that we covered with this REIT is a prime example of what's going to happen. Investors are going to get wiped out. That's what's going to happen, right?
It reminds me a lot of what was going on in 2005, 2006, and 2007, honestly, where you're starting to see people that are living in interest only. Remember that? The big phase. Hey, it's interest only. You can't lose. And there's people that have very little equity, to the point you made earlier. And I think that at just a few notches over, you've got people with no equity that have a serious problem that have started banning these. You start having people that just leave the properties, and you're left with a lot of financial institutions left holding the bag.
Which gets us to commodities and gold and silver, which you're an expert on. So I want to talk about those. But before we do, let's take some questions. Let's see what we have here from our audience. All right, Emily Medvec. She is actually one of our agents on our referral network. WAFED is in several western states, including New Mexico. How can we find out where those 2,000 multifamily properties are located? Do you know, Shad? I mean, is that public record when they sell these notes? Or I wouldn't think so, but can they find out where they are?
I have no idea on that one.
Yeah. All right. Let's take another question. I was reading an article about the depression in Tacoma, people living in cars and shacks and thinking we are in a depression. And Shad, I have to say, man, I was shocked.
Yeah, I live by Tacoma, and it's about an hour away. I go through there, and there are people that have set up whole rows of RVs that have then built onto them wooden structures, cardboard structures, tents, tarps, and there's people living in the street. And I thought, well, these people, I was expecting them to look a certain way. When I saw them get out, they were people that look like they should be in a home, and they just look like average folks, but this is how they were living now because they couldn't afford the housing anymore. And there was so many problems in the greater Tacoma, Seattle area that they passed a law that says you have to move your RV every 3 days or else we're going to seize it. Because what had happened is whole streets were taken over, and people that own the homes right by that street said, look, there's people that are living in front of our house and they haven't moved for months. So I believe completely what's happening in Tacoma is symptomatic of what we're going to see in more cities.
Our homeless population I don't think has ever been this bad.
Yeah, I'm in the epicenter of it. On the West Coast, it's particularly bad from California all the way up to Washington, and it continues up into Vancouver and in British Columbia. And it's because of sometimes the policymakers think they're helping people by not saying anything, but all it does is fester like a cancer, and it grows. I have never seen it as bad as it is now, and obviously Seattle makes the news a lot because the tent cities are so big, and they move from one area, then they move to another, leaving a bunch of garbage behind. But sometimes they're by schools and they're selling drugs, and it's a negative situation, and those will get removed. But a lot of them just sit there and nobody says anything. And to get to the store or to get to school or to get to your church, you're going by homeless encampments.
Some of them aren't very friendly.
Not so much.
And, I was really shocked. It wasn't, I mean, I thought, well, first of all, Seattle's a beautiful city. And I didn't feel, even though there was a lot of homeless, it seemed like a lot of drug use right in the streets, actually. I mean, we watched it. And, but I was really shocked at Portland.
Portland, I travel there. I have friends down there. We go there a couple times a year, and every time we're there, we have to be very cautious. Where are we actually parking? Where do we have to walk? Where are we going to be going? Because it's a little more aggressive. And again, I don't think everybody is a street urchin and a drug user. There's a lot of families that are just out on the street and they have nowhere else to go, and they're living in their cars or they're living in vans. There's a lot of van lifers, but you're starting to see it grow and grow to the point where policymakers won't do anything about it. People are fed up with it, but they think they're helping people by not saying anything. So they've actually started moving people in Portland and in Seattle into vacant commercial real estate buildings. But that's got people that work two jobs saying, hey, I'm working like crazy just to afford my little micro housing. Why are you giving them the nice places downtown that you're renovating? But they are moving people into these large commercial real estate buildings. I've heard that's been a train wreck as well, but it is starting to happen here on the West Coast where people are moving off the street into vacant commercial real estate. So it's being repurposed. Whether it's going to be a long-term fix, nobody knows, but it's kind of been a wonky ride.
So they're just inviting them into opening the doors to or are they squatting? I mean, are they just opening the doors and saying, come on in off the street? Or are they actually breaking in and squatting?
Both, but there's actually been city funds that have been put towards bringing people off the streets into commercial real estate buildings that were unused and even into hotels that were vacant. There's been several hotels over the last couple of years in Seattle and in some of these other cities, also in California, that are filled with people that used to live on the street. Now they've got nice hotel rooms.
But yet we kept the Fed interest rate to zero, probably for an entire year longer, increasing home prices by another 25% at the low end, which could have been cut short. I mean, imagine if we would have stopped this madness a year earlier, actually did it in 21 versus 22. I mean, where if you can see where people are obviously buying like crazy and overbidding, obviously you should slow that down.
Yeah, when you've got people piling on and when somebody puts a property for sale and you have people offering even more and foreign buyers coming in from other countries to even offer even more, cash only, no inspection. When you start seeing that kind of behavior, that's what a market top looks like. That is a topping action. And I think if they had slowed the roll a little bit faster, the Fed, and started reining it in, we wouldn't have had that easy money train turn into, hey, now we're going to have a real rubber meets the road moment in these markets. And I think we haven't seen anything terrible happen yet. So everybody thinks, hey, the economy's okay. We're going to be fine. I think it's a process. And I think as the next year rolls over, you're going to start seeing more and more people saying, hey, it's not just homes, it's car loans. I just hit a deer on a road in Washington, had to go buy a vehicle, and I got a 7.5% car loan. I said, well, I've got an 820 credit score, which is a pretty good credit score. He goes, oh, yeah, that's the lowest one I've seen in a month. I was like, well, what are other people paying? There's people paying 9, 10, 11% for vehicle loans. Well, what are they paying for small business loans to meet their payroll? And if they can't meet their payroll, what happens to those jobs? So I think this higher for longer, it's not just going to be about real estate. It's going to be about the vehicles. It's going to be about the auto industry. And it's going to be about business loans supporting small businesses. That is the backbone of small business. And when small businesses can't meet payroll, guess what? They're getting rid of folks. And when those people don't have jobs, now we're in a snowballing effect.
You think home prices are going to come down?
I do. I think they'll probably come down by 10
You
to
said
15%.
10 or 15%. You think that's practical?
I think it's practical, and I think that there's certain areas that are overpriced that may come down more.
What do you think the catalyst will be?
I think that it'll be when you start having the realization, or when you manage real estate agents, when they start having the realization that they're not selling as many homes, that they're not getting that 3 to 6% commission anymore because there is no buyers left for these things. There's not going to be people that are going to be transitioning from one house to another because the lateral move makes no sense. If you've got a home and you're paying 3.5% on it, why would you go and get a house where you're going to pay 7.5%, 8% on it? You're going to stay where you're at. So I think the moving around is what always circulated money. And I think that people are not going to be hopping homes anymore. And at the very entry to this, entry level homes, there's people cramming into this micro housing. There's people in Nashville, as you highlighted, cramming into these places for $2,000 a month with a fancy foosball table and a pool. They're not going to go out and buy the home. So when real estate agents are sitting there and when home builders are sitting there and saying, hey, where are all the new people? I think it puts a real break on the whole thing. And then certain areas, it's going to be worse than others, like it always is. Certain cities are going to take it on the chin worse. Maybe they're down 20, 30%. I think it's going to be enough that it's not going to be a crash, but I think it's going to be a corrective move in the real estate markets where if the rates stay higher, the only thing you can do is bring prices down. You've got to adjust for the higher rates.
Well, you say it won't be a crash, but here's what happened in 2008. It wasn't everybody that just couldn't pay their bill. I mean, imagine buying a house for $500,000.
In Seattle,
and your
I'd love
neighbor, say again?
In Seattle, I would love that.
Yeah, well,
They start
I mean,
here at
you
$1
could
million.
say $1 million. You could call it whatever you want.
Yeah.
Let's say $1 million. You buy a house for $1 million, and we have a price correction of 30%. That's $300,000. That's $2,100, $2,300 a month less than what you're paying for loan, right? Now, that would be catastrophic for people to say, "Nah, I'm just going to stop paying my mortgage."
Well, that's really what started the great financial crisis.
That's
with
what
people
happened.
that couldn't pay their mortgages. Yeah.
And people that wouldn't pay their mortgage, that refused, that made decisions and was like, I'm going to take advantage of this ability to dump, and I'll go short. I'll do a short sale. A lot of people didn't realize that they were getting whacked with tax liabilities because that went as income when you didn't pay the bank what was owed. Does anyone believe we will get a housing market crash? Where we just that maybe that was up there at the same time I was asking, and I was just kind of feeling that question instead of reading it. It's a mental telepathy, I guess. All right. Anyone else feel like these real estate investors never see themselves as the problem? What do you think about residential real estate investors, mom and pop investors? You think they're done? Finished?
I don't think so. I mean, I used to work for a gentleman named Robert Shimon, who's written about 14 books on real estate investing, and he would do courses and he would bring people in. And I met a lot. I mean, I met hundreds every seminar of these mom and pop investors. And a lot of them had a couple properties, maybe 3 to 7 properties. There's always going to be a market for that. And obviously, if things do correct by 15% or crash by 30%, that's a great opportunity for investors if they think things will come back over time. But I think there's a lot of people that are trying to get out of real estate. I've talked just anecdotally, a lot of people that have 2 or 3 properties and they're thinking about getting rid of them all, selling them all, so they can just put their money somewhere safe and put it in a CD making 5%. They're trying to get out of the game. I do think you're going to see an exodus of people that were mom and pop real estate investors that decide to exit the space, and that's going to create a little bit of a glut for a while. And then maybe that larger companies, like look at the BlackRocks of the world trying to buy everything up. It could be that larger funds come in and try to buy it up, but a lot of the funds have even started exiting some of their home positions, and they've started dumping hundreds of houses on the market, so they're not stuck holding the bag and the repairs and the high cost of maintaining them. So I think there's always going to be a pool of people that want to be real estate investors, but there's going to be people that leave the game.
Let me change the way that I asked that question. You think real estate investing is a good gig to get into in today's world? If you bought the house 20 years ago, 25 years ago, obviously, you're pretty safe, right? You're cash flowing. But you can't cash flow in real estate right now.
Yeah, right now it's a little dicey. I would wait for the corrective move, and then I would have money on the side waiting for maybe a turbulent period of 1 to 3 years, maybe longer, but then there's the opportunity. But if you're in it right now, trying to get into real estate investing now would be a tough challenge, I think. That's why I'm in commodities.
I wonder how many books he's selling now.
He's living in Colombia and Costa Rica when he's not here, and but I think a lot of that changed. The dynamics changed. I think the go-go years. I think the easy money's been made.
Who is it?
What's that?
Who's the guy? Who's
Robert
the
Sheeman,
Okay.
Sheemin. He was
Gotcha.
he used to do things with Anthony Robbins and Robert Kiyosaki. He was doing stuff with Trump when Trump was a real estate investor, doing buildings in New York and was doing courses. And I used to actually be the guy in the back of the room handling the private coaching for him and the courses for the real estate. So I saw enough of it to know that there's always a new group, a new patch of people coming into the space. I do think, to your point, it's tough right now to try to get into it. But I think that if there is some carnage, that's usually where the opportunity is. So maybe in a couple of years.
But then you have to think about the tenant landlord laws.
Well, and nobody would have ever thought we would see a period like we did during the lockdowns where you literally couldn't collect. You couldn't make people pay you, and you couldn't raise your rates. That's the wildest thing we've ever seen.
It's still happening today. I mean, just because they don't have the moratorium on the rents, it takes a year in a lot of states to get a tenant out, a squatter out, let alone a tenant that moved in with a valid lease that just decided not to pay you, right? It's the craziest thing. I think a lot of our property rights, I don't know. I think it's sailed. I think the ship has sailed. Let's talk about gold and silver for a minute, because you're not my average gold and silver guy. I mean, I've had multiple podcasts with Peter Schiff, Mike Maloney. Clearly they have gold companies, and a lot of times the audience pushes back a little bit and says, of course they're just pushing their gold, on their website. But you can't deny the fact that gold is really rallying. And I want to talk about this new law that Alabama just signed. And this article here on fxstreet.com, signed into law, Alabama abolishes income taxes on gold and silver. Now, this article, it's pretty new. You were saying that this is pretty revolutionary. They're not the only state that has done it, but let's look at this. On May 14th, 2024, Alabama's governor, Kay Ivey, signed a bill that removes all income taxes on capital gains from the sale of gold and silver. I'm on my way to Alabama. I'm going to move there. Enabling the state to take an important step forward in reinforcing sound money principles. With this move, Alabama joins a growing number of states prioritizing the protection of citizens, that's interesting, against the deleterious, however you say that word, effects of inflation, currency debasement, and mounting federal debt. Enactment of Senate Bill 297 makes Alabama the 13th state in the nation that does not impose capital gains taxes on the sales of gold and silver. Now, you didn't know that. I told you that, Shad, when we jumped on here, and you were unfamiliar with that happening. What does that mean?
Well, I do think it's a return to sound money principles. And what got me excited about this sector 15 years ago, 14 years ago, was this concept that you could get money outside of the fiat system. Because if you have anything, a paper asset or real estate, and it's tied to US dollars, you're still tied to a promise that a nation's made. Well, a nation that's drowning in debt, a nation that's constantly raising the credit limit like a kid with a credit card wanting more candy, as you mentioned. And so gold is an uncurrency. Gold is beholden to nobody. It's a third party. I don't have a gold company. I'm not selling any gold. So you can't make that accusation of me, but I like it because you're basically diversifying out of the banking system and the fiat system, something that's a store of value. And as the old adage goes, if you had a gold coin in the Roman Empire, you could buy a nice suit. Today, with a gold coin, you can still buy a nice suit. A gold coin today that's 1 ounce is worth about $2,400 and some change. That is an inflation protection over time. It doesn't necessarily move lockstep with inflation, but over time, as prices rise and as currencies get devalued, gold is like a Tupperware storage tank for your funds. So it's a great place to store wealth. And to a lesser degree, silver is the poor man's gold. So it kind of factors. So what Alabama is doing here is they're taking away the taxes on it, not treating it as an investment. They're treating it like a real currency and a return to sound money. I love it. I think it's a great idea. And I like that 13 other states are doing the same thing.
What do you think the driver is for gold to be hitting these all-time highs? Now, it has retracted a little bit, but it's still over $2,400 an ounce.
Yeah, it's 24.24 right now on the futures market, and that's what most people look at as far as when they're investing with it. But I think there's a multifold facet. One is that we saw the Fed go through the most crazy rate hiking cycle that we've seen in 30, 40 years, and that would normally pressure gold. But instead, gold responded by anticipating the eventual other side of the equation, which is they're going to have to start loosening. And they saw that the effects of this what would they be on the commercial real estate, what it would be on consumers, is eventually pricing that in. There's geopolitical tensions built in, of course. I think that's always a factor. But I think the biggest part that's really driving gold is the East. There's a big movement from the West to the East. You're seeing people in China buy gold hand over fist because they don't like what their country is doing, the yuan. There's people in India buying gold and silver for the love trade. There's the fear trade and there's the love trade. That's the wedding season because they wear the gold and silver as wealth. And a lot of them have switched to silver because gold's gone up so much. So there's also a lot of exchanges. The Shanghai exchange actually is setting the price more now than what you're seeing in London or what you're seeing in New York. So I think the biggest change is the movement from West that looks at it as an old relic, as a pet rock. They call it boomer rocks. And I think that there's a movement in the East where there's the youth buying these things called gold beans. And they're basically fractional parts of gold that are like little beans. And they put them in jars. And there's young people, social media trending about investing in gold. So it's part of the culture there. Here it's seen as a weird old relic. But I central banks don't see it as a weird old relic. And I think the biggest thing that's probably supported gold through these rate hiking cycles and through the tightening was that central banks all over the world are buying it because they see United States using their dollar, the world's reserve currency, as a weapon. And they saw Russia get kicked off the SWIFT banking system. And they said, you know what? That could happen to us. If we get on offsides with these guys, why don't we go ahead and get a little more of our balance sheet out of fiat and into gold just for safekeeping? And it's not a lot. Most central banks hold 5 to 10, maybe 15% in gold, but they've added enough that it's been substantial. I think that's what's driving the price of gold. And I think that bodes well for people that want to store something outside the fiat system. It doesn't bode well for fiat currencies.
Do you prefer physical?
I think everybody should start with physical, but I prefer companies that mine the gold out of the ground and silver out of the ground because I'm more on that side of the business. We interview CEOs of companies every day. I'm usually sitting in your chair where I'm interviewing somebody telling me about how profitable their business will be pulling gold and silver out of the ground. And then also royalty companies that are getting a small piece of maybe dozens of mines and managing that money. So I'm interested in playing it in that way. But for a conservative, get your money out of the market, you want to have physical, or you want to have a way of redeeming it for physical. You don't want to just have paper assets. But if you're trading and just hedging your paper assets, a lot of people do use ETFs and they use electronic gold. A lot of people would say that's a problem because if the internet goes down, you don't have any gold. But I think you start with physical and then you branch out into things that maybe have exposure to gold in other ways.
When you say you like investing in the mining companies, are you talking about domestic companies?
Most of the companies are domiciled in Canada, the United States. Some are Australian, but they're mining all over the world. And I looked at it years ago as like, if I'm buying gold right now, it's $2,400 an ounce. If I'm buying it in a mining company, it may be $100 an ounce. Would you rather buy gold for $2,400 an ounce at Costco, or would you rather buy it for $100 an ounce in the ground from the company pulling it out? And you get that leverage to the price appreciation. Well, if gold makes a move of 5-10% higher, many of these stocks will move 3x, 4x to that. So you're leveraging the gold. Now, there's inherently more risk because it's a mining company. They could have all kinds of problems.
And they do.
And they absolutely do. But there's a way to leverage the amount of gold. So it's not without risk. It's not as safe. It's kind of two different things. Buying gold is for safety. Buying gold stocks is to leverage what you think will happen to gold. I could see the writing on the wall years ago on the financials of what was going to happen. I knew it'd be going higher. And so I like getting the leverage on companies that pull it out of the ground. Not for the meek of heart, though.
Do you know Jim Rickards?
I do. I think he's been a good advocate for the sector.
I think Jim just said something like, and I could be wrong, but I thought I heard him say that he expects gold to hit 20,000 an ounce. Does that sound right?
There's people that have thrown out wild numbers for the last 2 or 3 decades. And honestly, as someone that's in this sector and in this space, it's a little bit of a thorn in our side, a burn in our saddle to keep saying it's going to go higher. But there's a situation now where something like 3,000 to 5,000 gold seems quite practical. I don't know, maybe 20,000 is legitimate, but I do know it's going higher over time like it always has. Let's remember that when gold was taken off the gold standard in 1971, it was $35 an ounce. Then it was hundreds of dollars an ounce. Then it was $1,000 an ounce. Now it's $2,400. So where will we be if we talk in a couple of years? It would not surprise me to see it in the multiple thousands because it's keeping up with the debasement of other currencies. Look at gold, not just in the dollar terms, but in every currency in the world. If you look at gold in Australian terms, Canadian terms, in the euro terms, it's up in every currency. So what does that tell you? It tells you one simple thing. Over time, all currencies fall in value, which means you have less purchasing power. And over time, gold is the teeter-totter on the other side of that scale, and it's going up to balance out the loss of purchasing power you have in the currency. So it should be a lesson to anybody that you should at least have a small portion of your money outside of the banking system.
All right, let's take some more questions. Victor Ashley, he's another one of our agents in a referral network, and he actually lives out by you. He's in Washington. So I've been advising my sellers lately that they need to understand who can afford to buy their Seattle home at $1+ million at these rates. Seattle homes are 10x average earnings. Yeah. I guess he's saying Dick's Burger.
It's a great place. People are out there till 1 a.m. in a line trying to get these burgers. Yeah.
Right. The new commodity in Seattle. So
cheeseburgers.
Yep, cheeseburgers. We appreciate you, Victor. 10X doesn't seem to work, does it?
No, and yeah, it's just amazing. Having moved here from Tennessee, I thought it was getting expensive in Nashville, and then I really saw the light when I came here and saw that starter homes were really at 800 to 900,000 or 1 million plus. And so it's a good question. Who can afford that? And that's the point we were making earlier. I don't know who's going to be able to afford these homes at 7 and 8% mortgage rates.
Yeah, it's crazy. I know we see a lot of people on the West Coast buying East Coast real estate, and they're really excited. I was just speaking with a plumber, and he moved here from somewhere in Southern California, and he said that people are complaining because of the $3.50 per gallon gas. And he said when he was gassing up to drive his car to Maryland, I think he said it was over $6 a gallon. So I guess, it is relative. Maybe salaries are more, they get paid more on the West Coast. But they are gobbling up a lot of the property here. And I think that's one of the issues why we're seeing such a the demand on the East Coast is because a lot of West Coast people are moving. They're domestically migrating to get away from a lot of the laws and different regulations. It's what
Not
I
just
hear
on the
anyway.
East Coast either. Also, look at Texas. Half the people moving to Texas from California. Look at people moving into Tennessee. Everybody was coming in from the West Coast because the housing was so cheap. And so you're seeing a rebalancing of real estate prices where people go from very expensive pricing to not as bad, but then that drives the pricing of those areas higher. So you're seeing real estate booms in certain areas, which are really people leaving the West Coast and bringing higher prices to the Midwest or to the East Coast.
Yeah. All right. Let's keep those questions coming. Brian, wow. Man, I think thank you so much. That is probably the highest super chat that we've received. So thank you, Brian. We appreciate all the super chats, but that is quite flattering. We appreciate that. I own 15 properties in downtown Atlanta in median income area, low interest rate, 4%. Is it a good time to sell? Stomach the capital gains loss and liquidate to gold. Which do you prefer? A, rush to gold and silver, capital gains tax, real estate. B, power through the 2025 Great Depression. Shad, you want to take a stab at that? Because I have my opinion on it as well. But why don't you start us out?
Well, I would never say you want to put everything into one thing or another. So I believe in diversification. I would say sell some of it, keep some of it. So that way you have answer C. You can power through the Great Depression in 2025 with part of your real estate because over time it will eventually go back up. I don't think you should put everything in gold and silver, though I'm an advocate for it. I don't think you should put anything into any asset class. I think you should spread it around a little bit. But I do think it's a smart idea to get some of it in something that's going to go up, even if everything else goes down. And again, not just gold being an uncurrency, but it's also kind of a chaos insurance policy. It's an insurance policy against a loss in government, a loss in central banking, belief that they can rein this in. But I would never suggest that you should put anything into any real estate, gold, or any asset class. I think you should diversify and keep your bets spread a little around. So that's how I'd look at it.
I have sold almost all of my residential real estate. I was heavier in Baltimore City. The writing was on the wall for me because I watched how they just penalized investors. This is from my personal experience. It took forever to get property redemption when I had bad actors not paying my rents. The condition that was, my property was left when I finally got the tenants out made it impossible for me to make any money. I would have to go in and basically re-renovate the property just to do a turnover. And I have a lot of experience. So this is not, they have a term called slumlord. The problem is that that's the only way you make money in certain markets. You have to be just callous, and that's not me. So for me, I wanted to make a nice, safe place for my tenants to live that they would take, pride in living in. And for me to do that, in my experience, was the only way to do it was to sell it at the top of the market. Now, I sold a lot of my properties in 2021 at the end of the year, and I sold them for top dollar. I could have squeezed out a couple more dollars, but I have watched that some of my properties that I sold, the buyer has already sold them and said, no thanks. And they sold them for more than I sold them in 21, but after transfer and recordation fees, which are ridiculous in Maryland, they basically broke even at best. Maybe it cost them a couple dollars after commissions, transfer recordation fees, and whatever they had to do to entice another investor to come in. I'm very happy with the decision that I made. I just closed last month on another property that is in the county. This was a 2-unit. I've been liquidating them, not even looking back. I don't even care about the 1031 exchange. I take my profits, I pay taxes on them, and get it over with. On to the next. I think that residential housing, and I've gone on record by saying this before, the ship has sailed. I do not think it's a good business to be in. Unless you have enough properties, and 15 isn't enough. Unless you have enough properties to have your own staff and you literally have them in a geographical footprint of where you live, that you can easily manage them and that you can have somebody working for you as your maintenance person to run calls, to, not putting them in the hands of a property manager who eats up all of your profit and leaves you poor. Right, where the property management companies, a lot of them, their whole game is to, charge you for failure to pays every single month, bang you over the head for repairs and service calls. And I never made any money when I had property managers managing my residential real estate, and I bought them all right. I bought them all very well, very profitable. Back most of them during the GFC, where I was buying properties for $25,000, $30,000, $50,000 in good areas. Okay. So for me to say, you know what, if you want to run that gamut, you think it's a good business, it's worth a try, but it's not for the faint at heart. And I think the ship has sailed. When I see these TikTokers and these Instagrammers getting out of their Rolls Royces and their Lamborghinis and throwing keys and whatever, selling courses like your friend selling books. And I'm not knocking him because, a lot of people that are successful write books about their success and they help a lot of people become successful. But at some point that dries up, right? And when you're competing with the downward pressure of people not being able to afford rents, and now you have squatters' rights where they can break into your house, take you 7 months to get them out, a year to get them out of your property, is crazy. I can't imagine who wants to be in that business and doing it for 25 years. I've been in a residential rental business for the better part of 25 years.
Just to play devil's advocate, could I ask you a question?
Sure.
With the low interest rate at 4% that he mentioned, do you envision, because I see a pattern of interest rates going up maybe for the next 10 years, 20 years, because we just got out of a 40-year bond bubble where rates came down for 40 years. A lot of the fund managers we bring on our show talk about interest rates going up, up, up. Do you think there's a time, though, where people will be sad that they sold if they had a 4% interest rate and they're unable to get that ever again, maybe for a decade or two?
Man, I tell you what, I'm not against real estate. Residential real estate is, I just don't believe in it anymore. But what I will say is I think that land, the right land, is a good investment. Of course, you're not making money on the land unless you're getting a farmer to farm the land, or you can have a parking lot. Parking lots are great. In fact, in Tennessee, I was talking with a real estate investor, and he said, if fire burned down my buildings or a tornado took them out, I would never build the buildings back again. I would build them, make them into parking lots, pay to park land. Because he said the amount of money that he makes on that is amazing return. Commercial space, contractor yards. I think contractor yards are going to be the way of the future. I think that we're going to see more blue collar workers be the best paid employees or employers, because nobody knows how to do anything. I mean, if your toilet breaks, no one knows how to. If your wax ring goes bad in your toilet and you start leaking water out from underneath, people, it's so easy to take a toilet off and throw a new wax ring down. No one knows how to do it. They can't change faucets. They're basically have no idea how to maintain a home. So anybody that can do that for people are going to make a lot of money, right? So there is no place for these contractors. They can't park their their trucks with their markings on them in a lot of communities, in HOAs or in apartment buildings or in condos. So they need a place to park their trucks. I believe in that. I'm investing in that, doing, contractor yards. You need a fence. They can put a trailer, office trailer, and they can put a spotter pot. They don't even need running water and sewer to these properties as long as it's zoned properly for their dumpster, their trucks to park behind a lock, and they have an office that they can operate out of, dispatch their guys. It's a great investment. Warehousing that's in manufacturing zoning, not like we talked about earlier, and just flex space. To get to your point with your money, there's opportunity in every market, but you can arbitrage that. If you truly believe that we're going to see a downturn, even for 3 years, you're better off selling high and buying low. So even if you want to stay in the residential housing market, depending on what you paid and when you bought, I don't see anything wrong with that. Selling and diversifying into other markets. But I just, the residential market for me, the rental market, I think is a losing proposition. Investors take me toe to toe on that all the time, but they haven't seen a downturn. Most investors have only bought post 2008. They have no idea what a downturn looks like, and it's coming. It's coming. If you think that it's not coming, it will be the first time in the almost 300 years that the United States has been in existence. It will be the first time ever that we haven't seen a downturn, especially after a bull run like we just had. If you think that that's going to happen, I could be dead wrong, and I'll be glad to admit that I am, but I don't think I am. I think it's hard to time because they manipulate things. But I'm voting with my feet. I'm selling off my residential properties, and I've been in the business for a long time. If you want to be, you think that these real estate investors aren't going to see something come. Depending on when you bought your property. But if you want to look at like Dave Ramsey, you can Google this. Dave Ramsey sold his house. You can Google it. Right? He bought another one, but he sold it. If he didn't think real estate would go down, he'd just keep it forever. Why would you ever sell a property? Why would you ever sell real estate? Right? You either bought it at a bad time or you're selling it high and trying to do something else with your money to protect it.
I was a fan of Dave Ramsey. I used to listen to him every day when I was driving because he's in Nashville, and he also built a very large commercial building that he actually staffed with a lot of people. So he may be one of the few people buying commercial real estate that has people working in it. But he's a sound money guy as well, and about not having debt. But if he's selling his house, that is a signal.
Well, he sold his house. It was like, I think it was in 21 or 22 or something. He sold it years ago and bought another house. But my point is that if you really believe what you're saying, why would you ever sell real estate ever? Right. A lot of people think that. They're like, you never sell, and if you do, you 1031 until you die. Guys, nice broadcast. Thank you. In terms of gold ETF, which one do you feel would be best value for our money in terms of truly tracking gold value? And then a bunch of tickers there.
I would say that on gold, I wouldn't go with the GLD because I believe who underwrites that is either Goldman Sachs or JP Morgan. I can't remember who does it, but they don't actually have a way to redeem the gold in the traditional sense. Certain of those ETFs, you can actually get physical delivery. Like I know, for example, that's not listed up here, but for silver, there's PSLV, which is the Sprott Silver Fund, and you can redeem it for real silver. So I would make sure that if you're doing it, not just through an ETF, even if you're buying gold in a repository, that you can actually get physical delivery of it. Because if it becomes a charged time where you really want to have that gold in your hand, you want to make sure that it's not just a promise on paper. You want to make sure you can actually get the gold in your hand. And so some of those ETFs you got to be careful with. You actually can't get the gold redeemed. They just give you cash. If you're trying to get out of fiat and they give you more fiat, that doesn't really solve the problem you have. But any of them are good for trading, for short-term gyrations. And what I mean by that is maybe you hold it for a year or two to get through a tough period. It's just if you want to eventually have gold in your possession, you want to have an exchange-traded fund that gives you a real redemption in physical. So make sure to read the fine print on those.
Let's check out our poll. Almost forgot about it. Brent, are you in the house? That was a short clip again of Brent Beardo. Where's our poll, Joe? Let's see what we've got him. He's like a jack of all trades here. All right. In the meantime, I don't understand the question. Is it asking if I add $10,000 to my bank account after paying my bills every month, or if I have a total of $10,000 left in my bank account every month after paying my bills? No. How much you have in your bank account after paying your monthly bills. How much money do you have in the bank after paying your monthly bills? That's all. Just what do you carry after your bills? And this is a little different from last week because, and again, to clarify, if you didn't hear me say it, took a little heat on, hey, I was asking the question the wrong way, which I completely understood. Because if somebody's mortgage payment is $8,000 a month, of course, they probably have more than $10,000 in the bank. But after they pay their mortgage, they have $2,000. Let's put that back. Where'd it go? There we go. All right. How much money do you have in the bank after paying your monthly bills? Less than $1,000, 33%. That's scary. 1 to 5,000, 25%, 5 to 10, 6%, still a large portion. So it's split up with really, you either have less than 5,000 or more than 10,000. So at 58% having less than 5,000 in the bank after they pay their bills. 58% of the people have less than 5,000 of our audience voting have less than $5,000 in the bank after they pay their bills. That means that any type of financial hardship and you are in trouble. Would you agree with that, Shad?
Oh man, it's startling to me how people are again, I just hit a deer and I had to do a down payment on a car. I also, when I was flying back from Washington, D.C. 2 weeks ago, had a root canal that caused an infection and I had to have a $3,000 root canal. Well, how would you do that if you have less than $1,000 in the bank or less than $5,000? What if I'd been hurt in the car wreck and I had medical bills? What if your child has medical bills? What if you have that home repair? What if your air conditioning goes out in the middle of summer? You're one problem away from bankruptcy. You're one mistake away or one accident away from clearing your clock. So it's really scary to me that it also just shows the point that a lot of people are living on credit. A lot of people are living on plastic. They're living on they're paying extensive, and when you see the interest rates go higher, that's only going to compound the poverty. So I think that it's real. I think it's a real issue, and I do think that it's a sad state that people haven't done a better job of saving. There's other cultures that really emphasize saving more than we've done. We've lived for the moment. YOLO, you only live once, and I think it shows in the numbers.
Let's talk about besides. You have, I think, in your past career, have worked with small businesses, right?
I have. I used to work with Fran Tarkenton, if you know that, is the quarterback of the Vikings, with doing small business consulting, and he was out of Atlanta. And it's an interesting to look at the small business market.
When we're talking about what do you do with your money, Brian, and with his question about do I sell the 15 properties and take a hit? Obviously, one of the ways that we become higher income earners is to have some type of passive income. And that was the love for being in the residential housing market before Wall Street got into it, before the massive appreciation that we experienced, before the ridiculous amount of inflation that made it almost impossible to cash flow for so many landlords, before we turned the laws against the landlords and weaponized the tenants against the landlords. I mean, for the first time ever, we said to these small businesses, you don't matter. You don't matter. You owe these people your business. That's disgusting. You bust your ass, go in debt, work hard, and then all of a sudden you can honestly be told for years there's no reprieve for you. The tenant doesn't have to pay your bill. After we propped them up, there was nothing in any of that stimulus that required these folks to pay their rent. If that's not writing on the wall, I don't know what is, right? So let's just take that. Now, with that, set that aside, because that ship has sailed, in my opinion, no matter what these Instagrammers say. You can't buy a property right now that will cash flow on a rental side. You're not buying a property in Seattle, Washington that needs work for $1 million and renting it for $10,000 a month. Are you?
I mean, I would say to your point about the passive income not being there in real estate anymore, there's other ways to get it. I just referenced Fran Tarkenton. He told me that one of the best ways to get it is residual income. So you could get it by being in insurance, but only an insane person would want to do that. I did it for 20 years of my life. You could do it by writing a best-selling song or book, but most people aren't going to do that. So that leaves you with very few options. I would say paper assets, you could do it with dividend-paying stocks. So dividend-paying stocks are the way you get passive income. And I would also say royalty companies are another way to get passive income, where you're getting a little bit off a lot of projects. There's a very limited pool of ways to get passive income now, especially if real estate's not in the game anymore.
How about starting a business?
Starting a business is like buying a job for 80 hours a week where you're managing teenagers, depending on the kind of business you're working. If you're talking about buying a franchise, I don't think I'd want to do that right now. And it's usually you're stuck working in your business. You're not working on your business. It depends on the kind of business. I love entrepreneurship. My father ran 15 different businesses, and he's raised me from a very young age. Son, you can either work for yourself or work for somebody else. I think it's great to get a side hustle going. And I think a lot of people do a side hustle as working a part-time job or maybe an Uber driver. But if you can get money working for you, which was your point with the passive income, there's not a lot of areas to do it. I would suggest dividend-paying stocks and utilities or energy companies that are paying 7 to 10% is a way to do it, and you're not taking any risk and you're not spending any time. Now, if you don't have any money to deploy, then you may have to start your own business.
Well, landlording is self-employment.
Absolutely. And it's just the question of, do you want to do the thing to make it profitable? Like you're saying, do you want to be fixing things? Do you want to be collecting rent from people that don't have to pay you? Do you want to be the one that doesn't have the rights because the tenants have the rights now? I'm not saying it's not a good business. I know people that are very wealthy through real estate. It's just you gotta pick what kind of battles you want to fight. And it sounds like, based on what you're sharing about real estate, those are battles you don't want to fight anymore.
I think if you want to be, if you were a landlord or are a landlord, there are three types of investors. Real estate investors. And I'm not talking about, residential or commercial or retail or office, or I'm not talking about a sector. There's three kinds of investors. There's one that doesn't want anything to do with it. They want to invest the money. They have a full-time job. They want to just put money in and somebody else to do the work, whether it's a property manager or whatever it is. They just want the returns, right? That's, unless you're really wealthy, not practical. Right? And we know a lot of people that have tried to do that. The great financial crisis was full of them. Then there's the hobbyist. They want to invest in the asset, the rental. They watch HGTV. They want to dabble in it. They don't mind sweeping the floor, throwing the stuff in the dumpster while they're watching the contractors, being hands-on, pick up the rents. That's a little better off because you have a little sweat equity and you're trying to learn about it, and you're better off than the one that thinks that they're just going to work their job, invest in real estate, buy it, or keep their house and turn it into a rental. I've dozens and dozens upon dozens of conversations with people that are in that category, the first category. It's a disaster. Then there's what I call the baller, right? That's their full-time work. They're geared to owning 300 homes. They pick a geographic area. They staff the people. They have it down to a science, down to the color of the carpet. They put black carpet in because they know it stains the least, and they don't ever replace the carpet unless it's the padding showing through. If you're in that category, you can make a lot of money by learning how to open up a plumbing or an electrical company, getting some kind of apprenticeship, hiring some trades. There's a lot of money to be made in that. If you're already doing that as an investor, man, I would put service trucks on the road and I would be making a lot of money serving the public that isn't going to fix anything because they don't know how. So I think there's a lot of ways in the real estate industry that I think the first two, it's not going to be successful for you. You've already seen massive price appreciation. If you think you can buy a house right now and you're going to see 20 or 30% year over year gains, ain't happening. And you're not going to see 20, 30% rental gains either. So when you're looking at the price and you're thinking, well, I'm going to pay the difference from what I collect in rent and what my mortgage payment is, you're going to lose.
Seems like the best business to get into is parking lots.
Nashville.
Based on what you were saying.
Yeah. If you were lucky enough to have a building and it fell down. All right, let's take some more questions. What's comfortable living? I don't know. I don't know.
Having all of your bills paid for passively. Like we're talking about passive income. Comfortable living is you don't have to go to work, but your bills get paid. That's the beauty of passive income. When you have enough of your assets working for you, then your asset can be anywhere you want it to be.
Yeah, I mean, I think the same thing. I think we have more physical ailments, broken relationships, and stress-related illnesses, period, being in debt, not being able to pay our bills. I think, but the problem is we live in a society where, and I talk to a lot of young people, and they say, look, I've got to get rid of my Instagram. I deleted my app. Now they've done this. It's like cigarette smoking. It's easy to quit, but it's easier to start it back up again. So, you get these Instagram accounts and they delete their apps, but then 2 weeks later, their fast is over on social media and they're back at it again. But they are bombarded with every new outfit that comes in front of their face on their phone with their peers that they feel that they just have to have it. And what we've done to pressure people into homeownership at these rates, we're still seeing people waiving their inspection rights. I mean, I'm working with a buyer right now. We've put 6 or 7 offers in, and it breaks my heart. The kids are coming, they're picking their bedrooms, they're not getting the house. We're still seeing crazy crazy activity on the very limited inventory that we have right now. People are giving up their inspections. Why would we be inviting first-time buyers into a home and pressuring them to not get inspections? If you're an agent recommending this, you're an idiot. Now, I know you don't make the decisions, but I'm hearing agents have conversations with, oh, I've got a guy for that. Don't worry about that. If you ask for that, you're not going to get it. Good, don't get it. You can't afford it.
I just like to share a concept with you because you brought up an interesting point about people being stuck on social media, being spending so much time doing that. There's a concept that was introduced to me years ago by a mentor, and it was just called the slight edge principle. A guy named Jeff Olson, he wrote a book called The Slight Edge. But basically, if you just spent 1 to 2 hours a day doing something different than you normally would do to generate some kind of growth, so it could be mental growth, spiritual growth, but in this case, let's say economic growth. What if you spent that 1 to 2 hours a day that you spend on social media starting a new business on the side? That's exactly what happened to me. I worked in insurance. I ran my own marketing company. But on the side, I was doing investing in commodities. And over time, it became my full-time gig because my part-time thing became the full-time thing. I think people can do that in real estate. What if you just spent 10 hours a week bird dogging deals for someone that was in the game and you got a finder's fee? What if you spent 10 hours a week networking with people to find who is a hard money lender, who's a rehab guy, how can I put a team together here? I think a lot of people misuse their time, and it's the most important asset that you have, your time. And I think if you just spend a little bit of time every week getting a little bit better, there may not be a difference at the end of the first week, second week, but you look at that person a year later, 2 years later, compared to somebody else that's on Instagram all week looking at outfits. The person that's spending an hour or two a day on something is going to become a master of their craft in 3 to 4 years. They basically got a college education on it in 4 to 5 years, and they become a master after 6 or 7 years. I think if you just utilized your time a little bit better, a lot of people would have more than $1,000 to $5,000 in their bank account right now.
And and I'm going to add to that because, and this is way off topic, man. But I think we all have God-given talents. We were created, right? I mean, we certainly, I guess there are people that don't believe in God. I happen to believe in God. And I think that we all have these talents. And whether you're working for a job, an employer and part of a team, which is certainly a great way to be, and you can grow as a team, and if you're not happy where you are, you can find another place. But I think the key to any success, whether we're working for somebody else and just wanting to win and escalate, and that is financially too, not just beating out your competition, but actually making the top, helping the company make money so that you can be an important part of that money, and then you can figure out how to invest, or whether you're starting a side hustle or starting your own company. What do you love to do? Because so many people are in jobs that they will never accelerate financially because they hate their job. And they're not good at it. And they get stuck in a rut and they spend 30 years or 25 years doing it. You can make money in anything that you would love to do. If you love mountaineering, you can make a fortune at that. If you love playing the trumpet, you can make a fortune at that, right? I mean, it's what do you love doing? And that's what you should really be doing. I know I said it was completely off topic, but that's what I see so many people miserable in their job. All they do is complain all day long about how they hate their job, but yet they don't do anything about it. And they're not making any money because you suck at it. Right? So your boss isn't just going to walk in the office one day and say, you know what? You got such a terrible attitude. You suck at your job. And I think I'm just going to give you a 30% raise. It will never happen. Unless, of course, you have certain jobs.
I think you make a compelling point because somebody said this to me flippantly, I don't know, maybe 10, 15 years ago, follow your bliss. I thought, that sounds great. It's a nice bumper sticker, but it's not real life. Real life, you got to work for a living. But the reality is, if you're spending time every day doing something that's your passion, you're going to feel invigorated, but also there's probably a way to monetize it. So if you like cooking, there's probably a way to teach cooking lessons on YouTube or on some kind of learning platform. If you like working on cars, there's probably a way to use that to create a side hustle for yourself. For me, I was spending all my time when I wasn't doing insurance and when I wasn't helping clients, trying to learn investing on the side. It's what I was passionate about. And now I try to help other people through my writing and through our courses and through the show that we produce, invest in companies and navigate those waters. It's because it's what I like doing. And then it became my full-time thing over time. And that can happen for anybody that's listening right now. Whatever you spend your time doing in your spare time, what is it that you really get animated by? There's probably a way to tie that into a side hustle or a business. And there's probably a way to not feel bad about it, but actually help other people because your passion will come through. So whatever it is for you, you could probably do that on the side. The reason that people get into real estate, if that's the focus of the show, is to try to create prosperity, to try to have more options, to try to have a better life. But it becomes, for some people, is a nightmare. And if real estate's your passion, you should do it. There's some people doing real estate, it's not their passion. They may be in the wrong game. They may need to look at something completely different, but maybe it's the means to an end. Maybe you do both. And so I just feel like you hit the nail on the head. I think a lot of people should follow their bliss. And while I shrugged my shoulders at that, it happened to me personally. And I got to say, I'm a lot happier. I have a lot less health problems. I'm not gritting my teeth at night and cracking my teeth because I'm so stressed out. And you'll actually find a way to actually be energized by the day instead of robbed from energy from the day. And I wish that for anybody listening.
Great advice. You may need to move.
Yep.
If you play music, you may need to move to where music is, you can be spotted, right? I mean, you may need to move to Nashville, right? Brian, wow. Brian, thank you so much. Todd and Shad, thank you. If you were a landlord in a landlord-friendly state, would that change your opinion? Number 2, will you post this video anywhere? What? We're live right now. It's posted right now, Brian. It's not going anywhere. And with low interest rates, with hyperinflation, let me get back to number 2. Will you post this video anywhere? If you go to Sachs Realty, a lot of people don't know this, but you at the top of it, if you click on the Sachs Realty channel, there is a tab that says live. So people think that these live shows disappear. They don't. YouTube just doesn't put them in with your time posted video. So right here, you could see that. Joe is showing you our channel. You have to click on the live link. You can sort it by the latest, the most popular. But this video will be hanging out there on our YouTube channel. We also post it on LinkedIn, Twitter, a couple Facebook. I don't personally like Facebook, but we have a lot of viewers that watch on Facebook, so we post it there. So yeah, it's going to stay out. With low interest rates, with hyperinflation, wiping out debt, does that change your opinion? And these are great questions. Look, my opinion is not everybody's opinion, and I could be 100% wrong. You know, I'm not saying do as I do, or I'm also not saying do as I say, not as I do. I'm consistent. So I'm telling you I don't like the business from that aspect of the reasons why. And I back it up by my actions of actually selling my properties and not buying any more residential property. So I'm actually living it. And I have a good friend of mine, Cliff, he was on the show. He's probably listening right now. But I can tell you, he said to me a couple weeks ago, man, I have to tell you, you do exactly what you preach. Because if someone is inconsistent with that, don't pay attention to them, whether you believe them, whether they're right or wrong. You give them no credit if they're doing something that's inconsistent with what they're saying, right? So I have consistently come on my channel and tell you that most of the real estate agents shouldn't be agents. You want to talk about getting into a career because nothing else has worked out well for you. This business is full of that, right? So, obviously I didn't stop at that. I believe in what I'm saying, and that's why I say it. But when we're talking about, Brian, what do you do here? So if you want to make money in real estate and you have capabilities or you have a thirst for investing in something that is a little riskier, but has a bigger reward, then get into building. Build new houses. Buy raw land lots. You should be able to steal them very soon for pennies on the dollar because no one's going to have any money to buy a scattered lot and build a house. So you should be able to look at a neighborhood, pick a lot, find a lot. People will just about buy anything right now, depending on how quick. It's a, ticking time bomb with, in my opinion, on if you don't do it now and you wait a year and a half to buy something and build something. But if you would tolerate a little bit of risk, build a spec house. Build something very practical. Make your money work as hard as you work. Don't just sit it in a house, a rental house, and throw the dice and hope you don't get a bad tenant. Because let me tell you something, you will. When you're buying Airbnbs, they say, oh, the Airbnb business is great. No, it's not. It's not great. The neighborhood hates you. Your neighbors hate you. They're outlawing you. And you're changing tenants every couple days. You're going to get a party house, and they're going to damage your home or your reputation where you won't even be able to pull up in front. Right? Now, there's exceptions to every rule. But let's be practical here. If it's easy money, everybody would be doing it and making money at it. Most people are failing at it. Most people aren't making money as landlords. That's why they get out of the business. That's why they start Instagram channels so they can tell you how to buy their book. Ask them how many houses they've flipped. Now, there are some legitimate ones out there, but I love it when I get this real estate investor pop up in my feed, and then I look and I'm like, how many houses do you have? You're 23 years old telling me how to make money in real estate. Come on, man. You haven't even seen a downturn. You don't know what it looks like. Don't even tell me how to do it. You're naive, right? But let's talk about what you can do. You can subdivide land. You can buy land that can be subdivided, and you can go through the county process. You can break it off and make 2 lots out of one. You can make 3 lots out of one. You can make 6 lots out of one. Higher risk, higher reward, but you're not dealing with people moving in your house and refusing to leave while they urinate on your carpet. Try getting that out. And it happens. So I think that, do I change my mind on this? I don't personally. I don't change my mind. I think there are ways to make money in real estate. Residential rentals, for me, no good. Unless you bought them 20 years ago, 25 years ago, and you've been keeping up on them and maintaining them, and you've had good tenant runs, then hey, keep them. But, this new wave of investors that have gotten into this business in the last 5 years, 7 years, you're in for a rude awakening. Things are not going to go well, I don't think.
What do you think about the last part of his question on interest rates? Because right now, again, I don't see interest rates ever coming back down to where they were before. I don't see a scenario where we get back down to near 0 or 2%. So if interest rates kept going higher and higher, would it make sense to hang on to properties that had a lower interest rate?
If you want to continue the pain.
Yeah.
I mean, if you get up every day and stub your toe on the same piece of furniture, and you're like, well, I just love that piece of furniture, and I can't seem to walk past it without stubbing my toe. I mean, you have to make the decision. If you're making money on them, they're cash flowing, and you're not having a bunch of hassle, and you're not having rent turnovers that's eating up your profits, and you're gaining appreciation on the house after you put $20,000 new heating and air systems and replace the roof for $20,000. And I'm throwing out these numbers. That's local here, but in California, it may be higher than that. You have to look at it. If you have golden handcuffs and you're not getting rid of your asset because you have a 4%, if you have 15 properties and you have 4% loans, you're not financed right. There's probably some bad applications out there that were filled out in getting loans, because you can't have 15, owner-occupied residences. I mean, I guess you can if you move every 2 years and you've been at it for 30 years, maybe you can have 15 loans that are now coming up as paid off, but most of your loans are not going to stay low interest loans. Now, let's suppose that the rates don't come down, which is a risk. We're probably not going to see 4% again. But let's suppose that they come down to 6.5% and sit there for a couple more years, right? So you trade your 4% for a 6.5% loan. You know, if you're in a commercial loan environment, you're not staying at 4% or 3.75%. It's not happening. And chances are, if you have 15 properties, they're in your personal name, which is opening you up for, you have no protection. So no LLC, no subchapter S, pass-through entities. I'm not an accountant, but I've been at it for a while. You're flapping. So any of your assets, if you get sued, are going to be wide open for the taking. Brian, they're great questions, man. I tell you, if you want to, I tell you what, I'd like to know more about your situation. Send me an email. I'll jump on a call with you. We'll talk about it. You can give me some addresses. You can tell me some of the fundamentals to the question. When did you buy them? What do you owe on them? What are your rents? Give me some kind of a financial analysis, and I can certainly help you better. But you're asking the question, which raises the point that you want more than what you're getting. That's just what I suspect. And there may be a way, if you can sell them, pay your loans. And a lot of it is, a lot of it is whatever your recapture will be. So, a lot of landlords don't realize they don't do any depreciation. They do TurboTax. So they're not using accountants, and they're not taking advantage of their asset depreciating, and they're not deducting that, which is a tax incentive for people that invest in property. Because even if you don't take it, you're going to get it. You're going to pay it back regardless of whether you take it or not. So if you've had the property for 7 years and you've been depreciating the asset, the structure, not the land, and you sell it, you're going to have that tax burden come back on you. It's not just the property, your capital gains that you're going to be paying. You're going to have some liability there. Talk to an accountant, which I'm not. But that all comes into the play too, whether you 1031 exchange, how bad will the hit be? And, at the end of the day, do you have enough profits to pay your taxes and move on into something else that will bring you a better return? And chances are you probably do with 15 properties. And there might be a better way for you to go a little bit higher in risk, but soundly in the real estate industry, but come out with a bigger profit at the end of the day. And that's what I'm all about. So, less aggravation, and your age has a lot to do with it too. I want less aggravation in my life. All right, do you think the housing market will ever be allowed to collapse with the government manipulating and controlling things like forbearance and stimulus? What do you think, Shad?
I don't know. It's hard to term the word collapse. I think the housing market has already collapsed in the past, and they did step in during the great financial crisis and during other periods of time. Like you say, it's cyclical. If you think that houses only go up, you're in for a rude awakening. And a lot of the people have never been through a down cycle. As far as the government manipulating, they're manipulating everything all the time, not just the jobs numbers like you were saying earlier, but they're too big to fail, putting their hands into all kinds of businesses and bailing them out. If we have the commercial real estate hit the banks, I'm sure they'll be stimulating there. If the housing market collapses, I think they'll definitely take action. Remember the stimulus from 2008 that the Obama administration did, where they were trying to stimulate housing. So I'm sure they'll throw money at it, which just means that all of your dollars are going to be worth less because they're going to be taking your money from a taxpayer and redistributing it back to other people that are in a tough situation. So I have no doubt the government will manipulate and try to do stimulus again and again and again. It's the only answer they know is to inflate their way out of the trouble that they're in. And so will the government keep spending? Of course they will. I don't know that is the answer to the question they're looking for, but I have no doubt the government will be stimulating more.
The problem is it doesn't help the middle class.
It doesn't.
That's the problem. So when we're looking at, and you can look up the definition of middle class, it and by definition is supposed to be the bulk of the populace, right? The ones that make things happen, not the elite and not the lower class or the lowest income earners. They're the ones that really take a hit with stimulus. Because as we see, they're the ones that can't afford to buy a house right now. They're the ones that, there you go. The economic group between the upper and lower classes, including professionals and business workers and their families.
The problem with this, any kind of stimulus, anytime the government comes in to give it, I remember watching your show just a couple of days ago just to get ready for this, and I was watching you talk about the college forgiveness. If the government's giving out money, first of all, the government produces nothing. So if they're giving out money, they're stealing from the middle class to give it back to people that are less fortunate. If there's a free college, if there's a home savior plan, if you're bailing out a bank, if you're bailing out an airplane company, if you're bailing out anything, you're taking money from taxpayers that could have gone to roads and bridges, and you're giving it to other people that misallocated funds. And who gets hurt in that is the middle class, because everything gets more expensive. Where do you think the inflation is coming from? Inflation is coming from too much fiscal spending. You're creating more money supply. That means that the middle class people don't have $1,000 to $5,000 in the bank account like your poll showed. So who gets hurt is the middle class.
Yeah, let's take a look at that poll one more time before we get out of here. So, and you're exactly right, Shad. The issue, I mean, look, now Fannie Mae's in the news on wanting to offer home equity lines of credit. So when you look at Fannie Mae has been bundling loans and selling them off to investors for less than what is owed. Here we go. 509 votes, 34, about the same. So we're about tied on those that have less than 1,000 and have more than 10,000. But the key is if 58% have less than $5,000 in the bank after they pay their bills. I mean, that says it all. And you guys are a very smart audience and probably hard workers and above average income producers. And you see what this affordability crisis is doing to us all. And but the question is, when we're looking at will the housing market crash because of stimulus? What we're having is an affordability crisis. We have an inventory shortage because of a lot of reasons that aren't being talked about. There are a lot of empty homes that are sitting in neighborhoods, a lot of empty units, condominiums that are, second homes, vacation homes. You have baby boomers that, to the tune of 30 million of them, over the next several years will be looking to either downsize or move their families into their homes and take those family members out of the home buying altogether, right? They'll be building accessory dwelling units, converting garages or basements, and we see it happening. Millions of millennials have moved back home since the start of the 2020 pandemic. I mean, we have a glut in multifamily housing. We have a glut in office space that the administration wants to turn a lot of that into more multifamily housing that we already have a glut of unaffordable housing. Unaffordable housing is not unaffordable to build. So if it's going to be subsidized, it's coming with more debt. And who's paying for that? Taxpayers. They're running out of revenue. So we're going to raise taxes. That has to be coming. who can afford to buy these houses? Who can afford to maintain them? We're already starting to see it. I tell you what, do this for me. Pay attention when you're driving through the neighborhoods. Look at the houses. You will find some of them in the neighborhood that show clear signs of distress. Maybe the shrubs are overgrown. Maybe the soffits are rotted. Maybe the shingles are falling off. Maybe the paint on the house or the siding is flapping in the wind. Look at these properties. We are seeing them everywhere now, right? You can clearly see who is being affected and is not affording to, being able to afford to live in the house. You can give all the stimulus in the world, but eventually that house needs repairs. So paying their mortgage payment or deferring their mortgage payment or kicking it in a loan remodification to the back end of the loan, reducing their monthly payment is not fixing their house. So who's going to fix the roof when it has holes in it? Who's going to fix the windows when they fall out of the house? You want to talk about equity. Now we're going to give home equity lines to people that don't have the money to pay their bills and to eat up the rest of the remaining equity in the house. Makes no sense. We need asset price correction. Period. It's either that or we need massive wage growth, and that's not going to happen because the businesses, and Shad has said it, the businesses don't have money, and their credit lines are drying up, and they can't afford the credit lines that they do have. Because if they get the loan, usually short-term loans for inventory and making payroll until their ARs come in, their accounts receivables come in, depending on what kind of business they're in, they're floating. They're floating bills, right? If everything doesn't go exactly as planned for these small businesses, they are out. Does that sound doomer?
It's not a rosy picture, but I think it's a practical picture.
And I hate to say it, man. I don't like this, okay? I don't like coming on and saying what's really happening, but who's saying it?
You're just keeping it real.
I mean, who's saying it?
Well, nobody's talking about the reason why people can't fix their properties. A large part of it is inflation. And if inflation is caused by giving out more things, bailing out more things, more fiscal, more government spending, then the answer is to quit spending so much on government. But the problem is they're not reining that in. That'll continually weaken your purchasing power, which means shingles cost more, lumber costs more, cement costs more, getting trade services costs more, getting people to do the landscaping costs more, gasoline and oil costs more. Everything's going up because the dollar's being debased. The reason it's being debased is because they're creating more dollars. They're creating more dollars to give more money away. So it's a virtuous cycle that puts people more and more in the hurt locker. I think a lot of the problems we have is the government intervening and trying to help people, and it may help one group of people, but it hurts the rest of the people. And I think that's the real fly in the ointment here. Is the reason we're having so much inflation isn't supply chain problems. It isn't just post-COVID stuff. It's the government creating too much money to give out on social programs that then drives the dollar down, drives everything else up in price. Now you can't make those repairs. Now to fix the air conditioning unit, it's at a price. Looks like you go without AC this summer. I think that's the real secret tax behind everything is inflation. And I think the problem with inflation is the government and their desire to help people, creating more and more inflation, making everybody more poor in the process.
100%. Well, look, Shad, we'll have to have you back.
Love to do that. It's been a pleasure to be on the show.
Absolutely. Great advice, great insight. And yeah, we appreciate you guys. Thanks so much for spending another Tuesday night with us. We love you guys. The best thing you can do for us, if you haven't subscribed to our channel, is do so. Hit the alert bell. You'll know every time we upload content. We post several times a week. If this is your first time joining us, we do talk real estate a lot. So it's not just the economy and geopolitical issues, which we do get into. You have to understand collectively, housing makes up about 30 to 35% of gross domestic products that are driving the economy. So when we're talking about inflation, a lot of it is housing inflation, not just rent or interest rates. Just like Shad said, it's actual repairs and maintenance, finding people that can actually do the work. And they have to pay more money, or you have to pay them more money because they're affected by the same inflation that we're all getting. But keep those comments and questions coming. If you guys are looking for agent help, obviously, if you're in Maryland, we'd love to be your company to help you with buying or selling, or if you're a landlord, filling your property despite the fact of getting you good tenants that I'm getting out of the landlording business, residential landlording. But we help landlords, but we help tenants too. A lot of people don't reach out to us in Maryland because they don't feel that we will help them on a rental, and we will. We work extremely hard for people renting that that need to find a good place to live. So reach out to us at ts@sachsrealty.com. Joe will put my email up there. And obviously, if you're anywhere else in the country and you need an agent, you can go to sachsrealty.com, scroll down to the map of the United States, click on your state and a city drop down, and hopefully you'll find somebody in a city near you. And if you don't, reach out to us and we will find one for you. This is a new program that we started this year, and we're really proud of our network, great agents, and we really do try and make sure that they align with the same way that that we like to treat our clients. And so anyway, Shad, any parting words?
I think the most important thing we talked about today was for people to look at how they could utilize their time better as a part-time side hustle. And if that's real estate, do it 10, 15 hours a week, build a network, start working on it every day. And over time, that slight edge will work in your favor. I think that's the biggest advice you could get from anybody, is to utilize your time more wisely.
Well said, and all of Shad's information is in the show notes. Cruise on over to his YouTube channel, subscribe to it. He has some great guests on, and it's an honor to have him on this side of the microphone. He's usually the host of the show, asking the questions, but it's nice to get him out of his element, and we hope to do it again soon. So we'll see you next time.
It's a pleasure to be here. Thank you for inviting me on the show, and hope to do it again.